Hey everybody, Anthony Walker here with Buckingham Investments. Welcome to our real estate investment fundamentals. We get a lot of questions from people on where to start. This would be it. So this is a basic sort of lesson that we've put together over many decades of working with investors, getting started in investing here in the LA area or on scaling up their portfolio. And everybody comes from a variety of different backgrounds. Some people have finance experience, some people already own properties and they're looking to scale up. Some people are just getting into this for the very first time. Either way, I think this is a great place to get started and just put some of these concepts together and start thinking about what an investment plan might look like for you. So first and foremost, it's really tempting to start thinking about real estate, look at some stuff on social media, maybe go to some seminars and get sucked into the idea of a deal or what kind of property you should buy or anything like that. Well, it's really better if you rewind and think from the very beginning on why you're investing and how it works and the mechanics of that. So we like to start with people on Finance 101. So we like to start with Finance 101. Now, if you've never taken finance or you didn't go to business school, this may look new to you, but it's really not that complicated. But in order to kind of frame our discussion and see where things go and think about the future for yourself, you really need to understand this formula. This is called the compound interest formula, also known as the time value of money equation. It's pretty simple and it goes something like this. Your future value of a sum invested today, that's present value, is worth that sum times 1 plus the rate of return that you're able to achieve on that investment to the power of n, where n is the number of years that your investment compounds. So sounds like a lot, but it's really not that bad. Let's just unpack the equation a little bit. We're going to use some examples and play with it. So this math is not unique to real estate. This is the same math. It's the same equation at play when you've got money invested in a savings account, a bond portfolio, growth stocks, S&P, mutual funds, whatever. Anything where your money works for itself enjoys the compound interest formula. And understanding how it works is what makes investing such a powerful tool to achieve financial independence for yourself. Okay? So let's check it out. You may be looking at our tiny little graph there in the bottom corner, and that's a great representation of why this is such a powerful concept. If you take the x-axis along the bottom, that is your time. So the number of years n goes along horizontally. The y-axis, the vertical part of the graph, is a representation of how much your money is worth after n time periods, or in most cases, n years. That little graph, or the line that goes through that little graph, or that line that has the parabolic curve that goes through the matrix, that's what your money is worth after n years. So if we just kind of chart this out with some samples, you could say right where x is 0 or n equals 0, that's where you make your initial investment. Where that line starts on the y-axis is the dollar amount of your initial investment. And then after however many years, where the line from the y-axis intersects that curve, that's what your future value would be, or what your money would be worth in the future. You may notice that the curve of that graph is exponential. The slope of that line accelerates with each subsequent year. That's the magic of this equation. That's what makes this so powerful. Because it's an exponential equation, and you have that n variable in the exponent, there's a power, that means that every year your money's working harder and harder and harder for you, the more that was there in the previous year to grow on itself. That's what makes it so powerful. Okay, so that kind of sounded like a lot. It's really not so hard if we put it into a word problem. So let's try that. We'll just take the algebra out of things for a minute here, and we'll just say, I'm going to invest present value dollars for n years at a sustained rate of return of R%, and I'll be worth future value dollars at the end of the plan. Now that makes a little bit more sense, right? We can start plugging in variables, thinking about our individual situation, and then we can just solve for whichever variable we choose to leave blank. What we're really doing here is we're playing with a financial calculator. Financial calculators do exactly the same thing. They're just calculating it for you in the background. So we could say we know what our present value is going to be, right? That's going to be our initial investment. We could say we have a pretty good idea of what n is going to be if we're trying to forecast what our money might be worth in the future after n years. We could say, let's plug in 5 for n and see what it's going to look like after 5 years, 10, 15, 20. whatever. We could approach it from a goal standpoint and say we want to get to future value net worth at the end of our investment plan. And we could say, I want to be worth $10 million. I've got $200,000, that's present value, to invest today. And what rate of return is it going to take me to achieve that in 15 years? So that would be our N. The only variable we've left out in that scenario is R. So what we're doing there is we're solving for R. We're figuring out what rate of return we would need to achieve on our portfolio, on our equity, return on equity, in order to get to that future value number. So you can play around with the variables as much as you want. You can daydream a little bit. You could either say, I think I can get this level of return for this many years, and this is what I have to start. What am I going to be worth in the future? Or you could say, I want to be worth this much. How long is it going to take me if I think I can get this level of return? Or any other number of examples. Really not that difficult. So what this really is we call this your general plan. Very simple, one sentence. Writing an investment plan for yourself doesn't have to be 20 pages long. It doesn't have to have all kinds of different scenarios and Excel analyses and all that kind of thing. Although, of course, we can help you do that too. This is really the most important piece of an investment plan. Just the fact that you're thinking about your goals at all and trying to quantify it is going to be the biggest thing for you. So I really challenge you to sit down, daydream a little bit, play with the financial calculator, and see how everything looks. Okay, so that's a lot of theory. But let's take a few different examples, and maybe this will help drive home the way that the compound interest formula works and what we can do when we manipulate some of the variables. So what we have here is a few different scenarios by manipulating the returns over a few other of the fixed variables. So let's say that we have $200,000 to invest in an investment property to get our portfolio started. That's a pretty good down payment to get something in our market. Might be a 2 to 4 unit kind of starter investment property. Very easy to get going. That would be probably 25% down on something. And we're just going to chart out how this might look over 25 years. Super long period of time, but it's going to help illustrate just how powerful this concept is. So first and foremost, you could say, I was raised to believe that all debt is bad, and if you can afford something, you should buy it cash. And I have my $200,000, so I don't want to go get a loan for anything. I'm just going to try and find a really tiny little property, maybe a small condo or an own your own, or maybe I'll go to another state or something like that, and I'll buy something $200,000 all cash. And let's say that your return then, the property just appreciates 5% on average. That graph in the upper right corner is basically what you would experience. You're still enjoying that compound interest formula, and you see that gradual parabolic curve in the chart, but after 25 years, if you plug in a 5% ROE into the R number of the compound interest formula, your $200,000 is now worth $677,000. That's fine. You've more than tripled your money. That's great, but you could probably do a lot better than that. Realistically, you can make 5% in bonds or in much more conservative investments than trying to deal with managing real estate. So if instead you used a little bit of leverage, maybe you got some debt, you bought a property, and you're able to get 15% return from appreciation, from leveraged appreciation, which is we'll describe in a bit, it looks vastly different. So just by increasing the returns from 5% to 15%, check out the chart in the lower left of our screen here at this point. Your $200,000 becomes worth $6.5 million after 25 years. Now we're talking. That's a lot more impactful, and you could potentially get those sorts of returns without investing any additional money along the way. Okay, so now for our final example, maybe you're super aggressive, you're comfortable taking on risk, you don't mind buying some fixers, getting your hands dirty, and putting in some sweat equity on your portfolio over the years. If you're able to achieve a whopping 30% return over the years for 25 years, your $200,000 would be worth $141 million after 25 years. Now, obviously, that's a little bit of an extreme example, and probably in most people's cases, probably way before you're anywhere near that future value, you're going to scale back the aggressiveness in your portfolio, and you're not going to take on as much leverage as you go, but it just really illustrates just how powerful this compound interest formula really is. That percentage is what controls just how quickly the graph accelerates, how fast things go vertical, and how quickly your money is working for itself as it's deployed. Okay, so let's plug in one of those examples into our little simple general investment plan. And let's take the middle one. I'm going to invest $200,000 for 25 years at a sustained rate of return of 15%, and I'm going to be worth about $6.5 million at the end of the plan. Sounds great. It's actually totally doable. Most of what's doing the work here is actually the passage of time. By far, that n number is what's going to be most impactful, right? For each additional number in that n variable, this equation multiplies by itself again. So the difference between 24 years and 25 years in this scenario is huge. At the marginal year, when you've got this much equity in your portfolio, you can do the math yourself. 15% of $6.5 million, it's a huge number, right? So we can convert this, now that you've got a pretty good chunk of equity, at any point in your investment plan to a passive cash flow number as well. So this is really useful if you're trying to figure out what financial independence might look for you, or where you have to get if you're trying to achieve a passive income goal. So at $6.5 million, it's a pretty safe assumption to say you should be able to make a 5% passive cash return on equity at any point in time. 5% of $6.5 million is about $329,000 a year. So that's great spendable income, and you can achieve that in 25 years and not have to sell any of those buildings, pay any of the capital gains taxes. You can continue to own those properties, continue to enjoy the appreciation, but also live off of that $329,000 a year in passive cash flow. This is a great way to do a general plan for your future earnings out of your investment portfolio. Okay, so here's the thing though. Very simple math. Obviously, we're generalizing things when we're using that time value of money equation. And it'd be great to just say, okay, we just plop our $200,000 in, we make our 15%, easy, no problem, right? Well, real estate's not quite that simple. That R percent number is made up of what we call 4 different elements of return. And all combined together equal that R percent, or that return on your total equity each year. And that R is broken up into appreciation, cash flow, equity buildup through amortization, or what we would also call principal paydown, and tax shelter benefits. So depending on which investment you pick and what your capital structure looks like, how much you put down, you can shift your returns between the different elements, and you can prioritize what makes the most sense for your situation, or even for that time in your situation as your portfolio grows and matures. So let's unpack each one of these a little bit. So first of all, appreciation. We've all heard of it. What is it? It's the increase of value of your property over time, right? Generally, real estate tends to appreciate over time as we get more demand for the physical space, and also as a result of inflation, the decreased purchasing power of the dollar. Those two together combine to typically make real estate go up in value over a long period of time. Now, we all know that real estate doesn't appreciate every year. Every year can't be an up year. But if we unpack some of the historical data, you'll see that there's a very long, broad trend of positive appreciation if you're a long-term owner. And we'll do that in a minute. Cash flow, everybody loves to talk about cash flow. Simply said, cash flow is the net spendable income you receive from being an investor in the property after all of your rents go to paying your operating expenses like taxes, insurance, maintenance, management, utilities, and also after paying your debt service, which is just your mortgage payments. So that spendable income, super important for a lot of people, especially those of you that are working towards financial independence, right? We want that spendable cash flow, that passive income. That's the reason a lot of people get into the game. After that, equity buildup through amortization. You may not have heard of this one before. It's a complicated concept for some people, but basically the idea is if you are using the rents that you're collecting from the building to pay your mortgage payment, assuming that you have a mortgage on your property, part of that mortgage payment typically goes to paying down the principal of the loan each month, and part of that mortgage payment goes to paying down interest, or paying the interest on the loan. Now, the part that goes to paying down principal can be expressed as a return, because at the end of the day, if you sell that property after a year, 2 years, 10 years, whatever, the value of your loan has been paid down significantly, and then that goes into your pocket. So we should still include that in our return calculations. In fact, you even pay taxes on that money because it is a benefit to you. We also call this principal paydown. And keep in mind, if you have an interest-only loan, this would be 0 because you're not paying down any principal. Last but not least, and this is a reason a lot of people get into real estate to begin with, is real estate enjoys incredible tax shelter benefits. There's a lot of different tax benefits that get super complicated, and I'm not a CPA, so I don't want to get into too much deep detail, but typically there's really two main things we're talking about when we're considering tax benefits as a real estate investor. Number one is the depreciation deduction. When you own property, rental property, whether it's commercial or residential, you can depreciate the value of the improvements over a certain time frame. With residential properties, it's 27.5 years. Commercial properties are typically 39 years. And that allows you to write off the value of the structure, or what the IRS calls the improvements during that time, and take it as book depreciation. So even though this is a non-cash expense for you, it's not something that you have to pay during the year. You still get to write off the income that you're receiving and shelter some of that cash flow that you're getting and not pay taxes on it. So it's an incredible benefit. There's all kinds of complicated, fancy things you can do with depreciation, probably a topic for another day, but it's really an incredible benefit that exists for real estate investors and it has the ability to deliver tax-free income for owners. In addition to the depreciation deduction, real estate investors also get to take advantage of something called the IRS 1031 tax deferred exchange. You've heard this probably just called a 1031 or an exchange or a swap. These are all terms for basically the same thing. And simply put, what that allows you to do is you can sell an appreciated property, and as long as you buy another property of equal or greater value, subject to some limitations, you are able to defer the capital gain tax that you would have paid otherwise had you just sold the property and pocketed the money. So that allows real estate investors over a really long period of time to grow portfolios. We can start with small buildings, we can sell them, we can 1031 exchange into larger buildings. You can sell one property and buy multiple. You can sell multiple properties and buy one. It's quite flexible, and it allows you to build a pretty large portfolio really without ever paying those capital gains taxes. It's a really, really powerful tool, and you should learn about it. Okay, so now that we've covered how the four elements of return work a little bit, let's look at a few examples because, like I said, depending on how you structure your purchase and what property you buy, different deals are going to have their returns in different elements of that are. So first, let's look at that all-cash purchase. So we mentioned low leverage, but no debt. So there's some advantages to that, right? With the low leverage, let's say we get a 5% return from appreciation. That's a pretty conservative number. We'll look at some historical data from that in a minute, but 5% is a pretty safe assumption there. Now, because we have no debt, you're probably going to get pretty good cash flow. You're not paying a mortgage, so it's fairly easy to go out and buy a property that should generate a 5% cash flow to you. In today's market, you might even be able to do a little bit better, something more like 6. So you get really good cash flow when you buy with no debt. That equity growth through amortization piece, though, that's going to be 0%, right? There's no loan, so there's no principal to pay off with the rents. On the other hand, there being no loan means that's all yours to spend, right? And then the tax shelter benefits. You still get to take advantage of depreciation when you own the property, and you get to offset some of that cash flow with the book depreciation. You can still take advantage of a 1031 exchange if you want in this scenario, but all of the percentages generally in an all-cash purchase are going to be a little bit lower, and that's because it's a lower risk, lower leverage type of scenario. All right, so we looked at our all-cash purchase. We talked about appreciation a little bit. Now let's look at some historical data. Buckingham has been around since the early 1960s, and we've been tracking local market data here in the South Bay, greater South Bay of the LA area since 1965. What we have here is probably my favorite chart in the office. This is 59 years of apartment building values going back to 1965. This is expressed in price per square foot, and if you can see the tiny type, you can see that in 1965, properties were selling for only $14 a square foot. That's crazy, right? In 2024, our average was $487 a square foot. So quite the increase. Obviously, if you've owned property since that time or anywhere in the past few decades, you've done really well. In fact, if we smooth out the trend from that 1965 number all the way through 2024, our average annual rate of appreciation on the value of property in this area, this is duplexes and above, so 2 units to whatever, 1,000 units, is about 6.2% every year. Our average value of appreciation during this time period was about 6.2% every single year. So that's really strong. If you remember, we were using 5% as our sort of baseline in the previous example. In reality, we outperformed that a little bit. Now, we're really fortunate here in the LA area to have unusually strong appreciation over a very long period of time versus maybe some of the other markets in the country that you might have experience with. If you think about it, the reason this chart is shaped like this is partially because of inflation, the erosion of the purchasing power of the dollar over time. Everything just gets more expensive, and real estate investors take advantage of that if you own existing properties. But a lot of what's going on here is increased demand over time for properties. We've had more people move to the area. We have an incredibly diverse job base. We have a gross metropolitan product of over $1 trillion here in the LA area. We're the second most productive metro area in the country after only New York City. And geographically speaking, we are surrounded by ocean on two sides, mountains to the north, and 100 miles of city to the east. So we have this artificial supply constraint, and it's very difficult to add new buildings to our environment here. So the net effect of that is we get very consistent appreciation over the years. Now, you will notice that it's not perfectly even, right? The real estate market is subject to cycles, just like the stock market to some extent. They're not tied exactly one-to-one with the stock market. They're loosely related to the business cycle, and the real estate cycles are affected by things like interest rates, the job market, construction, all these sorts of things. But generally speaking, we have this uptrend. A couple details that you notice when you start to look at the cycles and you dig in a little bit. When we do have a downturn, and we inevitably have a recovery after that downturn, we always surpass our previous high. So you can see going back into the early 1970s, we had a downturn. We went from $18 a square foot to $17 a square foot. Came back through the 70s. We had a lot of appreciation during that inflationary period. Topped out in the early 80s at $86 a square foot. That's about a 400% increase in values. Then we had another recession. That slid down to $85 a square foot in the early 80s. And then again, we started appreciating again. We passed our previous high. And in 1991, we topped out at $140 a square foot. Again, early 90s, we had a pretty bad real estate recession, savings and loan crisis. And from 1991 to 1995, we went from $140 a square foot on average to $114 a square foot. That was a pretty bad one. But once again, if you were a long-term owner and you just held on and you owned your properties, you did just fine. That recovery coming from the mid-90s at $114 a square foot all the way through the early 2000s, real estate completely ignored the dot-com crash in 2001, and we raged up to $329 a square foot in the subprime boom that topped out in 2007 at $329 a square foot. Obviously, most of you remember what happened, or maybe you read about it if you're just getting into this now. We had the subprime crash, the great financial crisis starting in 2008. Real estate values tanked over the period of 4 or 5 years. We lost 30-some% of the values here in the local area. Other areas were hit even harder, and we came all the way down to $205 a square foot, bottoming out in 2011. Once again, if you thought you had the worst timing in the world and you bought real estate in 2007, but you were patient, we came recovering back in the 2010s, and by 2016, we were passing that previous high again to go up to 2021 when we had all that pandemic-induced money enter the system, super low interest rates, and now we're in another down cycle here in early 2025. So where we go from here, nobody really knows on a year-by-year basis, but me personally, I'm willing to bet with a 60-year trend, and I'm perfectly comfortable making the assumption that we are probably going to recover past our previous high, and in fact, this might be a great time to take advantage of the market cycle a little bit since we're in a down market right now. Is that enough on that?
Yeah. I was expecting, so this should be good, yeah. That's good.
All right, so I mentioned that a big component of appreciation is inflation. So what we can do is we can back out the demand side of that equation and we can see how things look adjusted for inflation. So what you're looking at here is the same chart, 59 years of values, but all in 2025 dollars. So this backs out that inflationary component of the chart and you see just the ever-increasing demand for real estate in the area. The same trend still holds true, but you can also see just how powerful inflation was. thinking about that previous chart, what a huge impact it had. In 1965, if you remember, we were at only $14 a square foot. Well, in 2025 dollars, that would have been $138 a square foot. Still an absolute bargain. Can't find properties at that price today, but it's a great illustration of just how powerful a hedge against inflation is for real estate investors, and it showcases your ability to take advantage of inflation by buying real estate and allowing it to go up along with the prices in the rest of the economy. Okay, so I showed you 3 different charts earlier with 3 different sample return on equities over time, over 25 years. One of them had 5%, one of them had 15%, and one of them had 30%. At this point in time, most people think, you're really overselling here, Anthony. This is kind of crazy. Nobody can make 30% on their money. Even 15 sounds a little bit aggressive. How is that working when you just showed me an appreciation chart that has 6% annualized and cash flow looks to be 3 to 5%, something like that? Well, what we're doing is we're taking advantage of a concept called leveraged appreciation. Now, it sounds like a lot at first, but it's really not too complicated. The idea behind leveraged appreciation is that when you buy real estate, most people, if you're using a loan, you're putting some of your own money down as a down payment, and you're borrowing the rest of the purchase price from a lender. Typically a bank, but sometimes there are non-bank lenders involved as well. A very common capital structure coming into things, especially when you get your portfolio started, is a 25% down with a 75% loan to buy a property. So we would say that's at 75% loan to value, or LTV. Now, thinking about this conceptually a little bit, if you buy a property and you only put some of your own money down and you borrow the rest of the price from the bank, does the bank get to participate with you in the appreciation on that property? No, they don't. You get all the benefits of owning the property. Of course, you have the onus of managing it as well, but you only ever owe the bank what you borrowed from them, subject to the terms of the loan. So your typical loan's a 30-year fixed loan, especially for smaller properties. You pay that down over time, but as the property appreciates in value, you get all of that appreciation. That goes to your equity. The bank doesn't get that. So mathematically expressed, that's what we call leveraged appreciation. Sounds like a lot, but let's look at a really simple example. So let's say we have $500,000 cash to invest. We could go out and buy a small property, maybe a condo for $500,000, rent it out. Again, we were raised to believe that all debt is bad, and if you can afford something all cash, you should buy it that way. That's fine. In that scenario, let's say that the market goes up 5%. So if we just do the math on what your return on equity from appreciation looks like in your all cash purchase, it looks something like this. 5% of your $500,000 purchase is $25,000. And your return on equity is calculated simply as the money you made from appreciation, $25,000, divided by your initial investment or your down payment, which in this case was the entire purchase price, $500,000, because you bought the property all cash. Surprise, surprise, your ROE in that scenario is 5% or equal to the appreciation rate. Not that exciting, right? Now, what if instead you took the same $500,000 and you went out and you found a little bit larger property, or maybe a lot larger property, for $2 million. You put the $500,000 down as a 25% down payment. You borrow $1.5 million from a bank, and you buy a $2 million property. And now we make sure that that $2 million property generates enough income to pay all the expenses and the mortgage. But what happens now? That $2 million property, let's say it's next door to that $500,000 property, and it appreciates at the same rate. Also 5%, right? 5% of $2 million is $100,000. And our ROE, or our return on equity in this example, is $100,000, the money we made from appreciation, divided by $500,000, our down payment, not the purchase price. What's the percentage? 20% return on equity. So it looks like a cocktail napkin trick, kind of a silly little thing, but hopefully that helps you understand how leveraged appreciation works. And yes, it really is just that simple in the real world. The trick is finding the right property where you feel really good about the appreciation prospects, but it also generates enough income for you to be comfortable owning it over a long period of time and taking advantage of this idea. Okay, so now that we understand leveraged appreciation, let's have a look at how the 4 elements of return might look like on a leveraged purchase. We have our 20% appreciation, as we saw from the previous example. We've got a little bit less cash flow now because we have a mortgage to pay. That $2 million building is going to generate more rent than the $500,000 property does, but because you still have to pay that mortgage, probably your return on equity is going to be less than 5%, at least at the beginning. It's probably going to be around 3%, depending on how you finance things, although maybe in some cases you could even get it up to 5%. Now you have that equity buildup through amortization. And at least with interest rates today, if we chart that out, that's a known number. There's really no variability to that because you can check your amortization schedule on a financial calculator. I can say with 25% down today on a new purchase, you're making about 3% in principal paydown or equity growth through amortization in that scenario. So we know what that's going to be. And then you get that tax shelter benefits as well. So that's that depreciation write-off as you own your property. So add all these together, now our 4 elements of return is looking a little bit more exciting. We're making 29% combined return on equity because we took advantage of that leveraged appreciation concept, and we're still able to own a property that pays for itself. Now it doesn't look so crazy when we were using those higher rates of return when we were talking about our investment plan at the beginning and showing how that looks out over 25 years. This is the way real estate investors build an incredible amount of wealth over a long period of time and set themselves up for financial independence. Okay, so it's really easy to generalize things, think about concepts, understand leverage appreciation, and think to yourself, okay, that's great. I guess I'll just go out and buy one then, and it doesn't matter what I buy, right? Well, obviously it does. We want to get a good deal, we want to pick the right property, and we want to understand where properties fall within the marketplace as we're out there kind of selecting which investment to take a closer look at. Now, depending on what property you buy, you're going to enjoy your returns in different elements of return. Some properties are going to appreciate more, some properties are going to cash flow more, some properties you can buy specifically to prioritize tax shelter benefits. So let's have a look at some super easy common metrics that you can use to identify what makes a good deal for you. Now, when I say good deal, you can use these to identify what makes a good deal versus the market and compare comparable sales. You can also use these metrics to identify what makes a good deal for you based on what your investment criteria is and what you're trying to accomplish with your investment. So there's really 3 super simple metrics that I want you to know. The first one is just price per square foot. We probably all heard of this one before. If you bought a house or you've looked around at home listings, very easy to understand how much is the physical real estate priced at per square foot of the building. Typically, we refer to that as price per square foot of rentable square footage, although sometimes there's also common area square footage included in there. Very simple, just price divided by square feet. So that gives us a general idea of how cheap the physical real estate is, and it's an easy one to use to compare one property to another. This is probably the most common metric that you'll see if you're looking at single-family investments, condos, or properties that are sort of hard to comp using their income. Pretty easy to understand. The next 2, though, maybe you haven't heard of these before. So the gross rent multiplier and the cap rate are income metrics for valuation. What does that mean? Well, investment properties primarily are valued based off of the income that they generate, right? So it makes sense that depending on how much income they generate, we would be able to identify what a property is worth. These are the 2 simplest metrics for doing that, and they're really going to help you understand whether what you're looking at is a good deal relative to the market and whether what you're looking at is a good deal for your own investment plan. So first, let's talk about the gross rent multiplier, or GRM. The math here is very simple. It's the property price divided by the gross scheduled rents. And the gross scheduled rents are just the building's rent roll times 12 for 12 months in the year. So a building generating $4,000 a month in rent, let's say that's a duplex, generates $48,000 in gross scheduled rents per year. That's how you do that math. You just divide that into the property price, and out comes your GRM. Another way to look at it is, if you think about it, if you come back to the equation, if we have price divided by revenue, or gross rents, it's a revenue multiple. So if you've looked at stocks, kind of like a PE ratio for stocks or an EBITDA multiple if you've thought about buying companies before, this is just a revenue multiple for investment real estate. It's a great metric for apartment buildings because the expenses on apartment buildings tend to be pretty similar to each other. It's not a great metric for other types of commercial real estate, but it is the easiest one to understand. It's the easiest one to calculate when you're looking at a big list of properties, and it's the hardest one to inject any subjectivity into it. So if we come back to the formula again, and we're thinking about just price divided by revenue, another way to look at this is the dollars that you're paying for every $1 in annual rent revenue on the property. So imagine, let's say we've got an apartment building priced at $1.5 million. It generates $100,000 of gross scheduled rents. We would say the GRM for that property is 15, or we're paying $15 in purchase price for every $1 in revenue that the building generates. So because that's what we're paying for each revenue dollar, in an ideal world, we would want to pay a lower GRM versus a higher one for a property in the same market. So the lower, the better relative to the comps, and the lower means more income. The less you pay for every dollar of annual rent revenue, the more revenue there is available to go to your pocket after paying those operating expenses and your mortgage payment. This can also be used to compare buildings to each other in the same market and decide which one might be a better deal, or to compare markets to each other as well. And we'll look at that in some detail in a minute. Okay, after that, we have the cap rate. So you've probably heard of cap rates before if you've done any reading on investment properties. They're an often quoted but often misunderstood metric. So I really want you to understand what a cap rate is and what it isn't. The math on a cap rate is the net operating income a property generates divided by its price or value. And now the net operating income is a little bit different than the gross scheduled rents. That's the gross scheduled rents minus the operating expenses, but it's before making any mortgage payments or debt service, as we would call it. So that allows us to compare different buildings to each other, different asset classes to each other, different areas to each other, because expense ratios in different properties are going to be different from each other. So all other things being equal, if we have good information and the correct expense information, the cap rate is going to be a higher quality metric than the GRM, but often we don't. We don't usually have perfect expense information when we're just looking at a big list of properties and we're thinking about which one to buy. So let's talk about the cap rate. Because you've got the income in the numerator of the equation and you've got the price in the denominator, it spits out a percentage, which is useful because what that is a yield. You could also say that the cap rate is your yield on total capital or your yield on purchase price when you buy a property. That's what the property generates to go towards paying your mortgage or to go to your pocket. So if you buy a property with all cash, your cap rate and your cash on cash return are equal to each other. If you buy a property with a mortgage, they're going to be a little bit different because you're using that NOI to pay the mortgage. A higher cap rate, unlike the GRM though, is going to be a higher cash flowing building. A lower cap rate is going to be a lower cash flowing building. So again, all other things being equal, you want to buy the higher cap rate building, but that's only if you're really dealing with kind of almost two identical buildings next door to each other. The cap rate is much more useful for thinking about risk and where your property might fall in valuation or compared to other markets than necessarily just saying, that's going to be my cash flow. So let's talk about what gets people confused when it comes to cap rates. Very popular metric, easy one to quote. Of course, the math is simple. People usually misunderstand it. You teach people how a cap rate works, first thing they typically do is they go online and they try to find the highest possible cap rate that they can find because that's going to be the highest possible cash flow building. While technically you're correct, what cap rates are really used for is to illustrate market value of property and the yield that investors in that market for that property type are willing to accept for their investment dollars. The market is very smart. They know what they're willing to pay. And so cap rates, first and foremost, are a market valuation metric and an expression of risk. They're super useful as a yield because you can compare them to other types of yields for other investment products. So we can look at, say, treasury rates, which most people would say would be your risk-free rate, the 10-year treasury being everyone's favorite. So where does our building's cap rate fall as we compare it to the 10-year treasury rate? We could compare it to dividend stocks. We could compare it to what we're getting from money market accounts. Or we could compare it to our mortgage rate. A lot of people like to do that because if you're borrowing money to buy a building, ideally you'd like to borrow money at a rate that's less than the cap rate that you can get on the building. We call that positive operating financial leverage. Right now, positive operating financial leverage is actually very difficult to do. Cap rates in the market are actually a little bit below what we'd call the cost of funds or the interest rate. So what's going on there? The market's sort of in flux. It's figuring itself out right now, and people understand that there are those other elements of return that aren't just cash flow when you buy a property. So they're willing to accept negative leverage in some circumstances if they believe in the upside of the deal. But let's come back to talking about the fundamentals behind cap rate. So if you think about it, if cap rates are an expression of the yield that investors are willing to accept for risking their capital, then by definition, the higher the cap rate is in the market or in the asset class you're choosing, the more risk you're taking on. It's like buying junk bonds for companies, right? You could get a great yield from those junk bonds, but the chance that those companies are going to go out of business and default on your bond is a lot higher than buying US government debt. And because of that, you're going to get a higher yield than you will if you buy US government debt. The same thing applies to real estate. So I would caution anybody going out there to just try and find the highest cap rate you can possibly find, because you are literally going to buy the riskiest asset you can possibly find online. I would not go do that. The trick usually is finding the right cap rate that generates enough income to take advantage of that leverage appreciation we already talked about. Hopefully you can find a little bit higher cap rate than the individual comps in the area surrounding you, because it is a great valuation metric to compare properties against each other, but also not so low that you're going to be losing out on the possibility of applying leverage to multiply your returns, or so low that you're going to be losing money every month for the privilege of owning that property. There is also typically an inverse relationship between cap rates and appreciation. So the super high cap rates, the highest cap rates you're going to find, those properties are typically not going to appreciate as much as the lower cap rates. Going for lower cap rates in nicer areas are going to appreciate more, but again, you're going to get less cash flow. So hopefully that makes sense. It helps your lens a little bit and frame where you might think the right cap rate for you would be. The answer is going to be different for every investor. Some people, that's a 5. Some people, it's a 3. Some people, it's a 7. All right? So from here, that sounds like a lot of finance theory. Maybe we're all confused by now, but these metrics make a lot more sense when we look at a little local market study. So what we're looking at right now is the fourth quarter of 2024 Buckingham Investments market study. So we unpack all of the data from the closed sales of apartment buildings in our local area every single quarter. We correct all the errors, and we publish this in our market research dashboard on our website. And what we get is really interesting. You can see in these cities a comparison of what the sales looked like for GRM and for cap rate last quarter. And if you're watching this in the future, it doesn't really matter. The concept here is the same. And what you can see, if you know the LA area at all, kind of makes sense with how we were describing the way that GRM and cap rate work. Some of the really nice areas are much more expensive on an income basis. So Hermosa Beach, if you've ever been to Hermosa Beach, beautiful. It sold, we only had 4 sales, but on average, the gross rent multiplier for those sales were 23.8, and the cap rate was 3.3% last quarter. So very low yield, high multiple, expensive to buy in Hermosa Beach. It's a beautiful beach town. Investors would expect a high degree of appreciation, a lot of pride of ownership. These are great properties to own, but they're not really going to allow you to use a lot of leverage to buy them, right? Typically, Manhattan Beach is even more expensive than Hermosa Beach, but in this example, there was only 1 sale there, so the data is not quite perfect. Long Beach, we do a ton of business in Long Beach. That's kind of middle of the road, about 15 times gross, as we would say for the GRM last quarter, with a cap rate in the mid-4s. But Long Beach has neighborhoods that span a wide degree of desirability, from the beach to other parts of town that are maybe a little bit less desirable to own properties in. And so it's really interesting to compare cities to cities here and see what investors are willing to accept for their capital that they're putting at risk. Now things start to make sense. This chart should help you narrow down what cities you might want to look at as you're considering what investment you might make with your money. And the right example could be, and the right answer for anybody could be any of these cities, depending on what your perspective is. Okay, so let's take a few samples from there and see how this might impact the metrics that we've been talking about. So we're just going to compare 4 different smaller 2 to 4 unit properties. Any of these might be suitable properties for you to get your portfolio started, depending on your criteria and what you prefer. But they're all going to behave very differently because of where they fall on this cap rate, GRM, and area quality spectrum. So first, let's look at this A neighborhood. If you know Long Beach, you know that Belmont Shore, it's beautiful. Everybody wants to be there. It's right near the beach. Properties are expensive there if you've looked at homes. The same thing is true of apartment buildings. So we have a triplex here in Belmont Shore. We would call that an A area. It's priced at $2.15 million. The GRM on this property is 19.4, and the cap rate is only 2.7%. So this is an expensive property. It doesn't generate enough yield to allow you to use a lot of leverage to buy the building, but for somebody that prioritizes appreciation and they don't want to use a lot of debt, maybe they want to live there, they just want a really nice asset, this could be a good choice. Now we've got our B neighborhood. This is Alamitos Beach, also close to the beach, but maybe not quite as desirable as Belmont Shore. This is a 4-unit property priced at about $1.65 million. Generates almost $100,000 in gross rents. And it's priced at about 17 times gross. The cap rate here is 3.8%. Still pretty expensive, definitely a lower cap rate than what you're going to pay for a mortgage rate. So this building might not make a lot of sense if you want to use a lot of debt or put a low down payment down, but it'd be a good building to own nonetheless. You're probably not going to have a lot of headaches here, and you're probably going to experience great appreciation owning this property. After that, we have what we would call maybe a C neighborhood. So this is on Cherry Avenue. This building is priced at $1.8 million. Again, it's 4 units. The gross rent multiplier is about 13, and the cap rate's about 4.8. Now we're getting into the space where, depending on your down payment, this property is generating a little bit better cash flow, and this is more of a middle-of-the-road type deal that would allow you to use some leverage to buy it, take advantage of some of that long-term appreciation that we've seen in the market, and be an owner that can get into something with a lower down payment. And then we have maybe the D neighborhood. This property is on Ellis Street. It's triplex. It's one of the cheapest triplexes in the city. It's priced at $655,000. 12 times gross, which is quite cheap for 3 and 4 unit buildings right now. That's a 5.3% cap rate. You should be able to buy this building with a minimal down payment, still manage to cash flow, and it's a great way to get a portfolio started. But you may eventually decide to exchange into larger buildings, maybe a little bit nicer areas. On the other hand, you're going to get better yield here. So hopefully that kind of puts this into perspective and helps show how cap rate and GRM work in a few real world examples. So let's compare how these properties might look versus the leveraged appreciation conversation we had earlier. So I mentioned there's a trade-off in cap rate versus appreciation. There's also a trade-off in leveraged appreciation based on how much debt you use to buy a property. So let's say you go buy a property in an A neighborhood. It doesn't generate enough cash flow where you can use much debt at all to buy it. You're in a pretty good situation financially, so you buy all cash. And if you were to buy that property over 25 years and you put that same $200,000 down, you're probably not getting anything in the LA area, but maybe you found an A area somewhere else. Your equity would be worth $2.1 million after 25 years at 10% return on equity. Instead, if you bought maybe in the B area with low leverage, 15% ROE, you can see that there's a huge difference. Now you're worth $6.5 million after those 25 years. And by the same ticket, if you were to buy in a C area, but you were able to put a low enough down payment that you could get 20% ROE over that time period, now you're talking about $19 million in net worth at the end of 25 years. And then if you kept everything in the D neighborhoods and you use super high leverage to buy and you average 25% ROE during that time, you're worth $53 million at the end of 25 years. So this is a bit counterintuitive. Most people, when they first sit down to meet with us, think, well, if I buy the nicest property possible, that's going to appreciate more, and that's my priority. And while that might be the case for the property itself, you might be giving up return on equity in exchange for appreciation of the property because you're not able to use the same level of leverage to own that property and enjoy the effects of leverage appreciation over time. It's a little bit hard to wrap your head around that, but hopefully that makes sense. Most people end up kind of in the middle of the road of these scenarios as they start to stabilize their portfolio and think about what makes sense for them. So hopefully all that didn't confuse you too much and you get a general idea of some of the concepts and the terms that we're working with to figure out what makes the most sense for investors in different situations. I don't expect you to be able to take this away and immediately pick the right property for you. And if you want to dive in even more detail, We've got all kinds of different tools, analysis, that market research dashboard, additional videos, some downloadable guides if you prefer to read. Check out our website for all of that stuff in the description below. Hope to see you soon.